Hello and welcome to this session in which we will discuss corporate capital loss from a tax strategy perspective. What does that mean? It means first you need to know what a corporate capital loss is, to be specific, because we're dealing with corporation. We have corporate and we have individual. That's one. Two, after you know what the rules for the corporate capital loss, now we need to learn how to use those losses in a tax strategy. What's the tax strategy? To reduce the taxable income, to reduce our tax liability, to reduce our tax bill. That's the strategy, tax strategy, obviously legal ways. Corporate capital losses tax strategy is considered a timing strategy. So we are using timing and when do we recognize the loss, and you're going to see what we mean when we go through this, because tax strategy could take the form of timing, could take the form of income shifting. Here it's timing. So the first thing I'm going to do, I'm going to go over corporate capital loss real quick about the main points in corporate capital loss, and specifically I'm going to emphasize on the losses carryover, and this is where we're going to have the room to use this timing strategy. So let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. First thing, we're going to look at corporate capital loss rules and explain what it is and make sure you understand it differs from individual. So we do have individual capital loss rules. Those are different. Let's discuss corporate capital losses. One, capital losses can only offset capital gain. So if you have capital losses, what can you do with capital losses? You can look at capital losses and offset capital gains. Now, I did not mention what's a capital gain or a capital loss. Basically, it's when you sell securities, bonds, stocks, capital asset that result in a capital gain or a capital loss. In other words, you cannot use those losses to offset other income like revenues or gains. You can only offset capital losses with capital gains, which is limited to that. Now, for example, for personal, just FYI, for example, you're saying, why are you mentioning this? This should make sense, capital losses against capital gains. Well, for individuals, you need to know that you can take up to $3,000 of capital losses against other income, against W-2 income, against ordinary income. That's not allowed for corporation, just in case you're wondering why we're emphasizing this point. Well, no deduction against ordinary income. Well, unlike individuals, corporation cannot use capital losses to offset ordinary income. So what can they do? They can only offset capital losses against capital gain. And there's no short-term versus long-term losses. In other words, for corporation, there's no distinction between short-term and long-term gains and losses. It does not make any difference because from a tax perspective, they're not treated differently. We don't treat short-term capital loss or gain versus long-term capital gain differently as far as taxation when it comes to corporate capital loss. We don't have that difference. Carryover losses, this is important. So if a corporation capital losses exceeds their capital gain, what does that mean? It means in a particular year, they have, $5,000 in capital gains and $25,000 in capital losses. We're gonna capital losses. We are going to net them, and when we net them, we're gonna have $20,000 of capital loss. Well, that capital loss is excess. So in this way, this excess capital loss, what are we gonna do with that? Well, the carryover rules allow the corporation to do two things. Either go back to the previous 3 years and amend your tax return, or take this capital loss and carry it forward for the next 5 years. So simply put, you have this $20,000 capital loss here. What can you do with it? You could go back 3 years. In other words, go back to the prior 3 years and do what? And if you have any capital gains, wipe them out and get a refund. Or if you don't have any capital gains in the prior 3 years, you can carry this for the next 5 years. And this allowed the corporation to apply the loss to offset capital gains in those years. Don't worry, we're going to look at an example with numbers. To maximize tax benefit from capital losses, what should you do first? Well, you should always go back if that's possible, because going back will give you an immediate tax refund. If you could go back, you have the loss this year, go back to the prior 3 years and wipe out any capital gain, you'll get a refund immediately by carrying back any capital losses to the previous 3 years. How do you do that? You go back and you adjust the taxes that you paid in those years, and you ask the government for a refund. Don't worry, we're going to look at an example. If any loss remain after the carryback process, they can be carried forward. For how long? For the next 5 years. And this strategy does what? It ensures that corporation utilizes capital losses to either get an immediate benefit through a refund or reduce their future tax liability. It's better if you can get an immediate benefit. Remember, a deduction today is worth $1 of deduction today is worth $1 today. In the future, there's the time value. You are deferring this deduction. You don't want to defer deduction. Let's take a look at an example to basically illustrate what we talked about so far. Let's assume Jackson Company, which has a taxable income of $150 in year 5. In the same year, they incur a capital loss of $30,000 from selling securities. In the preceding year, they had realized capital gains as follow: year 2, $10,000, year 3, $3,000, and year 4, $6,000. So this year they have too much capital losses. What are they going to do now? Well, most likely the best way to approach this is to take those losses and go back to year 2, offset the capital gain year 3 and year 4, right? Because you want to get an immediate benefit. To keep on going with this example, the corporate tax rate for all relevant years is 21%. So to maximize the current tax saving, what should Jackson do? Opt to carry back the entire $30,000 to offset those capital gains in year 2, 3, and 4. And you will start with year 2, 3, and 4, result in an immediate refund. So how does that work? We're going to go back to year 2 first. Well, we have 30,000 and we used up 10. How much do we have left? 20,000. Good. Do we have more gains? Yes. So the 10,000 is gone. We have in year 3, 8,000. We're going to take of that 20,000 and use 8,000 for year 3. And we're going to be left with 20,000 of capital losses. And that's going to wipe out year 4. We're going to go to year 4 and use the 12,000 to offset this 6,000 of a gain. And we're going to have extra after using all the deductions, an extra 6,000. So after this transaction, we would have utilized 24,000 of the 30,000, the 10 plus the 8 plus the 6. Well, and we did not use the whole thing. And just to give you the benefit of it, we got 24,000 in capital gains multiplied by 21%. We have a refund due from the government for $5,040. Now we have remaining $6,000 because 30,000, the initial capital loss minus the used up 24, we have 6,000. What can we do with this 6,000? We're going to work an example to see what we're going to do with this 6,000. So the remaining 6,000 of the capital loss would be carried forward to offset future capital gains available for the use over the next 5 years. So this strategy, it allowed what? Jackson to leverage their capital loss to get an immediate tax benefit. What's the tax benefit? A refund, going back to the prior year, amending the return, and lowering your taxes. And what's left, it's going to help us lower future tax liabilities, specifically when it comes to capital gains. So make a note of the $6,000 that we have not used yet. So the ability to carry over this 6,000 capital loss to future years can create strategic opportunity for tax planning. And this is what we care about here. Since these capital losses have a time limit and expires after 5 years, what we have to do, we have to kind of use them up within 5 years. Now, if it's unlimited, that's better, but 5 years, it's still good. So we have to use the right time to use them. Now, what's the right time? We'll work an example. This strategic move ensures that the company uses these carry forward before they lapse, before they expire, essentially by recognizing capital gains. So when do you use them up? Well, once we have capital gains, we could start to wipe out those capital losses. The company can offset these gains with the carry forward losses, effectively reducing the tax burden. So simply put, assuming the 21% tax rate remain, so $6,000 times 21%, they have a potential future savings of $1,260. So this approach not only prevents the loss of valuable tax asset, the carry forward, but also allow the company to manage its taxable income more efficiently. So for example, in a particular year, you might have some capital gains. You want to go ahead and execute them, sell them to use up the loss. So let's take a look at the previous example and carry it forward. Let's assume Jackson, year 6 through year 10, they did not engage in any transaction that resulted in capital gain or capital loss. Remember, we still have $6,000 of carryover, but now we did not sell anything. However, we have an unrealized gain of $60,000. Now, what's unrealized gain? It means we have some securities. Those securities went up by $60,000. We did not sell them yet. Because if we sell them, we do realize the gain because we don't want to sell them. But we have this unrealized gain. And given that capital loss carry forward expires in 5 years, now we need to act strategically. This is where planning is important. So the $6,000, they would expire after 5 years. To make efficient use of this carry forward, what's going to happen is what we should do in year 11, the last year, we should opt to realize, we should opt to sell and realize 6,000 of the 60,000 unrealized gain. So do what? Get a gain of 6,000 capital gain, then use the capital loss of 6,000. And that's good. We used them and we saved ourselves 1,260. We realized the gain, but we did not have to pay the taxes. And this allowed Jackson to offset the 6,000 realized gain. But you might be saying, well, this is not the right time. I don't want to sell these investments. Well, sell them, get the tax benefit, go back and purchase the investment again. It doesn't matter. It doesn't make a difference. There's no such thing as wash gain. Gain is a gain. It does not really matter. As a result, the 6,000 gain realized in year 11 would not incur any taxes, and you'll be able to use up those $6,000 of losses, and you did not lose them. Well, let's assume you don't want to repurchase the securities again. That's fine. You still have 54,000 of future gains. Hopefully, they will stay at gains. And look, having gains, it's not a problem at all. Sell them, get the gain, and pay the taxes. It's always good. But if you have a capital loss, yeah, we would reduce your income. Through this strategic maneuver, Jackson successfully leveraged its expires capital loss carry forward to offset a portion of its capital gain. 6,000, that's fine. You save taxes on 6,000 because if you did not execute that trade and realize the $6,000 gain, you would have lost the 6,000 of carried over capital losses. Let's take a look at this multiple choice question from farhatlectures.com. Adam Corporation had a gain of $10,000 in year 1, $8,000 in year 2, and incurred a capital loss of $25,000 in year 3. How should Adam Corp utilizes the capital loss for the maximum benefit? We have the loss. What should we do? What's the maximum benefit? Get the deduction now. How do I get the deduction now? I'm going to take the $25,000, take it back to year 1, where I have the $10,000. I have a $10,000 gain. Take out the gain. Then I'm going to have $8,000 loss in year 2. Again, what do? Use up $8,000. And I wiped out $18,000 of capital gains. I'm going to get a refund immediately. This is what you should do. So what answer illustrates this concept? Carry the entire loss in the future? Well, what if I don't have any capital gains in the future? And if I do, but the time value of money, my losses are worth less in terms of deduction. No, I don't want to take this. I don't want to take this risk. Carry back the loss to year 1 and year 2, then carry forward the remainder. I would say this is what I explained. I will keep this as an answer. Apply the loss to reduce ordinary income in year 3. That would be nice if you can, but you cannot reduce ordinary income from capital losses. Carry back the loss only to year 1. Why only year 1? Why not year 1 and year 2? You're allowed to go back 3 years. No, so the best answer is B. Carry back the loss to year 1, year 2, and any remainder you carry them forward. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you are studying for your CPA exam or studying for your accounting courses. Invest in yourself or any professional certification. Take your education seriously. The CPA exam's worth it. Good luck, study hard, and of course, stay safe.